There's so much data that's come out recently. I think we need to refocus and really look at what matters. So we're going to take a look at what Fed interest rate pricing looks like currently. And then for today's Trading Takeout, we're going to focus on why you should try and only use limit orders when entering a trade. But before we look at all the important stuff, make sure you like this video and subscribe to the channel so that I pop up in your YouTube feed every day to improve your trading edge. Right then, it is a big day today, the first FOMC meeting of the year. And in front of you, you can see the probabilities for what the target range will look like for this meeting, basically what they're going to vote for, whether they're going to hike or cut. Now, the way to interpret this is you've got the meeting date, obviously, here. And this is taking what's called the term structure of all the different contracts, the Fed funds futures contracts, and basically putting it into a nice visual so you don't have to interpret it yourself. So the contract ZQF4 is the January contract, and that basically denotes that we're looking at this target range for this Fed meeting. It's what the market derives from what the pricing is, basically. And you can see here, there's a couple of ways which they show you. It's very easy to interpret. Now, the chance of no change is 98% roughly. So we're expected to maintain interest rates at today's meeting. There is a slight chance, a very slight chance of a cut. But I would completely price that out. Now, this is where understanding macro comes in. And the chance of a massive shock here could be on the cards, of course. You know, Powell could be looking at the layoff situation and unemployment possibly ticking up and saying, oh, let me just ease a tiny bit. Let me just ease like 25 basis points. Or what could be said is a narrative-based ease, where he says in the press conference something that implies easing. That can sometimes cause the market to maybe reprice like 5 to 10 basis points lower, at least for the next meeting or something, okay? So there's different ways in which they can jawbone rates around. They can change, you know, how the market perceives things without actually changing the rate. And it's very slight, and it probably would be quite nuanced, but you tend to find these differences in the speech after. So they tend to keep the speech relatively fixed and then change different words around. And the guys over at New Squawk, after each speech, they've got an algo which basically goes through each speech and then shows you the difference between last time. Then you can make a judgment on whether it's, you know, more hawkish or dovish. But I think key here is to look at what goes on in the forward meeting. So if you look at March, for example, we're currently priced actually almost 50-50 between a cut and a maintain. So a no change and a cut. And so, you know, this would mean that the curve is effectively looking like that. And I can show you the actual term structure of it, but let me just quickly grab it up. So if we go on to Quick Strike, which is fantastic, by the way, CME bought Quick Strike. And it's a really good tool because you tend not to have these advanced tools available to you in terms of the options and futures realm, especially when it comes to interest rates. But it's a fantastic way to start really understanding sort of options chains. It's a great way to understand, especially with interest rates, how they're being priced. But you know, the CME tool as well is fantastic. The tool there, which I just showed you. But if we go down to Fed funds, might take a little while to load. Let me just share this tab. Go down to Fed funds, then we can see, and we go to futures info. And this might be, for some people, a little bit of a better representation. You know, you might be able to then understand exactly what we're talking about and how interest rates are derived, because it can be quite confusing. It's a very different market. And I'm pretty sure that I've shown this before, actually. But it's always relevant to go through it again. So yes, if we look at how we are priced here, basically the 29th of the 12th was a much more dovish curve. Okay, it was a much more dovish curve. So what you do is you take 100 and then minus this number, and then that is the target range in basis points. So here, for example, if it's 94.67, the target range is between the target range is 525 to 550 basis points, okay? Because all you do is take 100 and then minus off 94.67, and then it's in between there, okay? But you can see here that we're predicted basically for interest rate cuts through 2024. This is a slope to the upside. If it were downward sloping, you'd be predicting hikes, okay? So this is a fantastic indicator as well of the bond market. This is why I'm quite bullish bonds. Seems like a strange trade, but I'm quite bullish bonds. And the reason is purely based on interest rates globally looking like they need to come back down. Obviously, if rates come down, then the bond price increases. And the closer you get, again, to the likelihood of QE possibly restarting, just accelerates that trade. Okay, it really, really accelerates the trade. The one thing to watch out for, of course, is if there is a liquidity issue, which means that you can easily get completely knocked out of a trade like that. So it's very, very important to watch that. But if we are focused purely on this March meeting, so next month's meeting, it's about 50-50 odds. May, and as we go into the middle of the year, May is looking at a 35.6% chance of a 50 basis point cut. So we'd have to cut 25 in March and then another 25 to get where it's priced in there. But mainly it's expected to maintain at a single cut from the March meeting. The June meeting, so bang on half of the year, we get even more dovish. We're looking at 34.2%. So 75 basis points from there. And then if we go into July, roughly, looking at the same tick down. It's basically a 25 basis point cut each way from next meeting, March's meeting. These things can change, though. These things don't just stay fixed. Like, that's just a probability of how the market is looking at things now. So this is why I say looking at the element of surprise is the most important thing, because data will affect these changes in probability going forward. And it's always the extent of the effect, not the data itself. If you can get that concept into your head, it's so important. It's the relative difference between the last piece of data and the current and possibly the next piece of data that the market cares about, not the data itself. Sometimes you see data coming out of places and it's absolutely awful. The fact is, everyone knows it's going to be awful, and so they don't really care about it, okay? And so this is why it's always the extent of the delta or difference between the last piece of data and this current piece of data that influences the most. Always look for who is stuck in a trade and who is going to be the most pissed off by a change in data. That's basically the best way to think about trading, in my view. You're looking to knock people out who are positioned really badly. That is pretty much what brokers try and do. And you want to trade as much like the broker as possible. They don't necessarily trade, they do more hedging and things like that. But if you can think of, who the dumb client might be when you're looking at a chart or looking at pieces of information and putting a story together, where might the dumb people have entered? You want to be trading against their flow. You want to be trading towards their stop and having your take profit at their stop. Try and conceptualize these things, because it seriously will help. Today's trading takeout is why you need to do me a favor this week and only use limit orders when you're entering the market. See, a lot of people tend to just use market orders. They'll just, hit the bid or lift the offer, just blindly pressing buttons. Now, what you're not realizing there is you could be getting slipped massively And if you're getting slippage, it means you're eating into your costs and eating away at any edge that you might have. Whereas if you're using limit orders, it means that you're letting the market come to you and you're getting filled at the price that you want. So try and make your trading as objective and as certain as possible. And one of the ways that you can do this is by absolutely using limit orders. As well, a good bit of advice, if you like, is to try and enter right where you think people are going to put their stops, which tends to be above highs and below lows. This is how you start getting closer to really flushing out the people that have put their orders and are working positions in stupid places. And these are the people that tend to get stopped out the most. So trade against dumb people's stops by using limit orders.